Hello, everyone. Welcome to this week's edition of Smart Counsel for Lunch. I'm Brittany Hinojosa Citron, an attorney here at Samuel Sayward and Baylor in Dedham, Massachusetts. We practice in estate planning, elder law, probate, and estate and trust administration. So today I wanted to talk about some differences in income tax between revocable trusts and irrevocable trusts. I feel like there's a myth out there that trusts can avoid income tax. Well, that's not necessarily true, but there are income tax differences between the two different types of trusts. So with a revocable trust, it's typically a grantor trust. And for income tax purposes, a revocable trust is tax neutral. So it's essentially ignored. All of the income is reported directly on your own personal income tax return. So if you have a revocable trust, you don't file a separate income tax return for the revocable trust. You just report the income on your own personal tax return. If you need a tax ID number for the trust, you would just typically use your Social Security number. There's no separate number while the grantor is alive, so the one that created the trust. And the income is then taxed at that individual's income tax rates. So that was a revocable trust. An irrevocable trust is different. So an irrevocable trust is usually treated as a separate taxpayer. So the irrevocable trust will file its own income tax return. It'll need its own tax ID number. And trusts, they can reach the highest federal income tax bracket very quickly at relatively low levels of income. Income retained by the trust is taxed by the trust, but the income that generates from the trust and it's distributed to the beneficiaries, that's generally taxed to the beneficiaries instead at their own individual tax rate. There's some irrevocable trusts that are intentionally drafted as grantor trusts, which means that the grantor still pays the income tax, even though the trust is irrevocable. So there's just different ways of drafting an irrevocable trust. It can change who pays the income tax and when, but most irrevocable trusts don't pay taxes on income because the tax is paid by the beneficiaries receiving the income. That's in most cases, especially because the income tax bracket for an irrevocable trust is larger than it would be for an individual. So typically the income is distributed out to the beneficiaries, and the beneficiaries then report it on their own personal income tax return. And if the income has been distributed to those beneficiaries during the year, the trust deducts on the returns it files, and K-1s to the beneficiaries are given to them, and that's the information they need to report on their own personal income tax return. So it's a little complicated, but those are kind of the the differences between revocable trusts and irrevocable trusts when it comes to income tax. So you can't necessarily avoid that, but you can determine who pays the tax and when. So thank you for watching, everybody. Please visit our website for other videos and articles relating to estate planning and probate, and also watch our other videos here on YouTube. Please follow us on social media, our Facebook and Instagram pages, and we'll see you again next week. Thank you for watching.